Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. Danny's playing drums over here. We got to watch him.
And the head drummer did not like it.
Got to keep an eye on you. You and Evan. I mean, Evan's playing keyboard when we start the show. You have to play.
I forgot you were the drummer. I'll do guitar.
All right. Just don't take my job.
I don't want your job.
You don't want my job. Nobody wants my job. That's right. Dan Hill with me today. This is exciting. We're on the new set. We got a new set at the office.
Very
you
nice.
Can't see it if you're listening on the. Well, you'd be listening on the radio right now if you're listening, but you can't see the set because this is not a video. It is a video show after it's done, though. So that's why you want to subscribe to the podcast. That is a big reason to subscribe to the podcast and be able to get those emails on the videos. So, yeah, that's we have. There's just a ton of stuff going on, man.
You got that right.
I read probably the best article on the Iran war today that I have read any place.
Wow.
Just getting what's going on, who's over there, the United Arab Emirates and Saudi Arabia, how they're actually approaching things, how the U.S. actually is just absolutely necessary. We had to be there to do what we did for them to get involved, but how they're getting involved. And we've known a little bit, we've heard a little bit about how they're getting involved because they were attacked themselves.
Right.
But how they're getting involved in the defense of themselves, and UAE a lot more than Saudi Arabia, actually. But it was fascinating to hear the dynamics of what's going on and how this whole, what's happening makes so much sense.
Well, where was that? Because the last I heard...
It was in the Wall Street Journal.
Okay, that's a good one.
Yeah.
Saudi Arabia wasn't going to let us use their air bases anymore.
Well, that's not to say. They are a little bit more reticent to get involved than the UAE is, but the UAE is getting it. But they are getting involved. And, we may not be hearing necessarily how much they're getting involved, but they are getting involved.
Right.
So that was fascinating just simply because the whole thing with our that whole region is that they tend to stay out, they tend to stay back, and you don't necessarily hear how they're getting involved in anything, or they're not getting involved. And we start to think, well, gosh, what are we doing? Are we lone wolves? Is this something that's going to really turn badly? But it was interesting to see how the Wall Street Journal talked about how the China and Russia influence on Iran and how that came about, and the weaponry and how... some of the stuff we hear little bits and pieces of, but it's probably the best article I've ever seen on it. So I sent it to you guys. In an email.
Okay, well, let me just say this, Paul, because it's kind of like you said. We just don't know. I watch a lot of the History Channel, and it's World War II history.
Right.
The show that was on this morning was about how U.S. industry, I think it was Exxon, GM and Ford, were doing business at the initial beginning of the Nazi takeover.
Yeah.
I mean, it's like, I'm 70. And
you never heard that?
I've never heard that. And I watch that stuff all the time, and I'm going like, what? Where's this been?
Yeah.
So that's what, 80 years old?
Well, it's so true. It's like so much of the information that we probably need to know or would like to know to make our better decisions as Americans. We don't know till years later or months later anyway. So yeah, that's some of that stuff is coming out right now, which I think is fascinating.
Yes, indeed.
So that, and then the other thing that there was in the news, you've probably seen the IPO, SpaceX IPO.
I did.
Making the news, the big deal, SpaceX IPO, all of these different publications writing about, you want to get involved in this. And, one of the things that we talk about around here is when we invest, you're investing, we only advocate for investing in things that are already out there, already public. IPOs, the problem is that IPOs tend to lose money in the first several months that they're actually put out there. And the reason that they get hyped up to the point where the price when the company comes out, a lot of them, not all of them, but a lot of them get hyped up so much that they have nowhere to go but down after they become public companies.
Yeah.
And what we have found is, historically, the last data I had seen is that typically want to wait about 9 months. So the funds that, in the investment vehicles that I like to use, they'll wait about 9 months at least. It used to be 6, and now it's like 9 is a typical good number on what to wait. And the reason is that you got somewhere in the neighborhood of 40 to 60% of IPOs are below their offering price within a year. So you have a high percentage, and forget about that the markets usually go up. So we're just talking about that they're below their price. What are they below markets? Well, studies go back decades, and I actually looked this up. I wanted to see what it had to say about it. It says studies go back decades show that most IPOs underperform the broader market over 3 to 5 years. And there was a large historical study by Wharton Business School where they found that 4 out of 5 IPOs underperformed small cap indexes over time, and that would be the appropriate benchmark because they're new companies, they're small companies.
Right.
You have 4 out of 5. So your odds of this working out well, but people they get excited about this stuff and they think they're going to get rich quick.
Well, so I thought that's where you're going to go.
Yeah.
Why are people doing this?
Yeah.
But the other thing.
Isn't that always the case, though?
Yeah. Well, I mean, like you said, it's because, the last time I missed the boat when whatever.
Yeah.
Nvidia,
FOMO,
Facebook,
fear
Google,
of missing out, sure.
Amazon went berserk. I'm not going to miss the boat this time. But it's interesting what you said, because I was watching a clip on one of the business channels, and whoever the talking head was says a lot of times these things double right off Jump Street. But you don't want that to happen. And I was going, why is she saying that? But now it makes sense because what you said. You don't want it to go up too high because it can only then go down.
Yeah, and they double, but who benefits from that doubling though? The person that owned the company.
Right.
That they put it out there and they have a price they set for it, right? And the person that owns the company, and sometimes there are a select few people, insiders, people that, I remember Barbara Streisand was a big one, that would get this stuff. And you go, well, why does she get,
What about Martha?
Martha, well, that was insider trading. That was a different deal.
Well, she was definitely insider.
That was a different deal. But you'll have, maybe a brokerage firm wants to throw a bone to one of their big clients and they'll let them in on something like this. So what happens, what an IPO is, for those of you who don't even know what we're talking about, initial public offering. The idea is initial public offering. You'll have a company that is a founder, in this case, Elon Musk. They develop an idea. And I often, when I'm teaching in classes, I'll say, hey, look, who are the wealthiest people in the world? I'll often start the education session this way. And, kids in the classroom will say, well, it's business owners. That's who the wealthiest people are. And I'll say, okay, so, and they don't get to it right away like that. They'll typically name a name and they'll go Elon Musk, Bill Gates, just people like that. And then I'll say, okay, what do they all have in common? They're business owners. And they get to the point where they get, oh gosh, I get to be a business owner when I own a company. Well, you'll have people like Musk and Gates and these people that start companies that will take tremendous risk. And then at some point they want to cash out. So they will actually go to an investment banker and say, hey, we want to take this company public. And the idea behind making it public is so that the general public, the American investor and international investors, so on and so forth, can invest in the company. And they'll set a price. They'll come up with a price that they want to put this thing out there. And then, just to start the ball rolling. And then what will happen is, people will start to bid up the price. And you can see it might double very, very quickly. And you go, gosh, who benefits from that? Well, it's, not usually the investors like like the general public that are investing in this thing that benefit from that, particularly because the hype, it just gets out of control. And then all of a sudden, the company's price can be very, very high compared to the earnings that are expected. And that's what you're buying when you buy a company. Think think about it this way. You're buying the rights to the earnings of that company going forward. Now you're buying rights to the infrastructure and those types of things. But a lot of times what happens is that infrastructure isn't in place when a company goes public. That infrastructure is going to be, the money coming in is going to be used to build the infrastructure. And so sometimes it can be super, super speculative. I remember one guy came to me, his accountant sent him over. And I'll never forget this. It was a huge company, a very well-known company. And this guy, he said, my accountant came over and said, I need to go talk to you. And I was like, you could tell he really wanted to be there. He really wanted to be in my office. It was pretty funny, Danny. Oh, you told me to be here.
You're going to the dentist, man.
I always like, yeah, that's exactly. It was like going to the dentist. So I said, okay, what's going on? Well, he was an employee of this very large company. And he said, we've gone public. And I said, I know, I've read about the papers, I know. And he said, he told me that I need to talk to you about diversifying this stuff. And I said, it's not a bad idea. And I said, so what do you got? And he told me how much money he had. And he said, it was several million, as I recall, in the stock in this company. And I said, well, yeah, that's probably a really good idea because you may end up going back to work. You're dependent upon working at that company. Now you're going to be dependent upon the stock price, and that can be really, really dangerous. So he says, but Paul, and I said, yeah. And he said, the stock has always gone up. It's always gone up. And I said, here's why it's always gone up. That price was determined. You'll have somebody that comes in and does an audit of the company and takes a look at it, and they'll do an estimate of its value, share price value. And they don't really know. They're they're using a lot of information to determine its value. Don't get me wrong. But they don't have what we have when we're dealing with public markets, where you have millions upon millions of people who are voting.
Billions.
Yeah, on the value of the company.
Yes.
On a daily basis, they're trading this stock. And it's this idea that when you have that many people with all disparate groups of people with different information, and they add their information comes together to determine the stock price, that price can change based on all kinds of factors that maybe a small group of people that did the valuation privately like that wouldn't be privy to.
Right.
Like tastes. Consumer taste, for example. Right. I'll just give you that as an example. You can surmise what the consumer taste will be for your product, but you don't really know. So what ends up happening is I said, it just went up and up and up. And I said, you mark my words. I said, once it goes public, you will not see that cascading upward movement in the stock price. Well, guess what he did? He didn't listen to me.
Surprise, surprise.
And what happened to the stock price? It went half.
Wow.
Now, I don't know whatever happened to this guy because he never worked. He never came in again. But all I can surmise is he probably kicked himself and was probably embarrassed.
Exactly.
Because, oh my gosh, that guy was right.
Yes. Unfortunately, we have to be the bearer of bad news.
Yeah.
And I think you're right. I think a lot of times I experience, they don't come back. They're going like, wow,
well, the embarrassment is too much. Yeah.
Yeah.
And it's sad. It reminds me of that story, one of our friends, Mark, likes to tell of this doctor, who didn't listen to him. He just felt like he knew exactly what he was doing. And I said, yeah, I've got this. I don't need to do anything. I don't need to diversify. I forgot what the heck the guy owned. But, ended up that he had a situation where he came back in years later. Now, this was back in, I think it was like 2000, around 2000, 2001, 2002, somewhere in the neighborhood. This guy's telling a story about it. The doctor comes back in, and he's a brain surgeon.
Okay.
And what happens quite often with people is that if they're really intelligent, they think that their intelligence parlays over into the investing world and that they have abilities that the normal average person just doesn't have. And ego can really, really get in their way. So this guy actually goes out there and he decides he's not going to work with our friend that does what we do in another state. He leaves and the guy just never hears back from him again until a few years later. The guy walks in, neurosurgeon, mind you, hand shaking like this. His hand's just shaking when he walks back in there. And apparently he had lost, I forgot what percentage. It was probably like 80% of the value of the stock had gone away, right? And he walks in and he says, I can't do neurosurgery anymore. I can't do it anymore. So he was literally toast. Wow. He said, would you work with my daughter? And it was, yeah, of course we'll work with your daughter. But it was, just sad.
Yeah, oh yeah.
That this guy had actually thought that, he really had this thing called investing down. And it was back when tech stocks were doing so well, it was a genius, on feeling when,
right.
There were, everybody's a genius, as they say, is what I was thinking of as I was saying that line. Everybody's a genius, especially in a bull market.
Yes.
When things are going well, right?
Yeah. And unfortunately, we see that everywhere, Paul. One of my clients just lost her job Wednesday or Thursday. And she worked at Caterpillar Finance Department here locally. And they're laying off 30, 40 people for whatever reason. And it's like an outsourced job. But and she was going, Caterpillar's up like crazy this year. So I don't pay attention to individual stocks. We don't do that. And it was up 155% or something like that.
Right.
Which is really, really good.
And now it's selling for what it ought to be based on what the future is likely to be.
Well, the future expectations.
Yes. Yeah, exactly.
Yeah. But,
those expectations better come through or it's going to come, cascading down.
Right. And I mean, she most of her money's invested. That's her little gambling account.
Oh, sure.
That, I tell them they'll have more fun if they go to Vegas and play roulette or craps or something than that. But it's the loyalty bias.
Some people like doing it.
The loyalty bias that we run into all the time that we teach about. The GM plant down here, the largest GM plant in the world. I don't know, the years better than me. You got better. Went down to $4 a share. What did all those guys own? GM.
Oh, it was amazing when that first opened. Yeah. The hype around that when it first opened was amazing.
And Costco's another one because my sister worked at Costco for 30 years, so I have a lot of Costco clients. And their stock has done very, very, very well. And it never goes down. Yeah. Like you said, it never goes down. And they are loaded up on Costco stock because it's been such a great ride, and it's hard to do that.
Well, that's the hardest thing is when somebody is successful with their gamble.
Yeah. Yes.
Then they believe, wow, this is skill. And they don't recognize that maybe it was just luck.
Right. And then we run into the problem we just talked about is now they're embarrassed. They're going to say, I told you so. And we're not like that. Okay,
right.
We want to try to save them at whatever point in time we can save them.
Shame doesn't help.
No,
you don't want to do that. And so often I just look at them and go, gosh, it's just our human nature, and it's just the way we're made. Hey, just a note to you, podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, like dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here on the Investor Coaching Show. I'm Paul Winkler. He's Dan Hill. We're talking money and investing. Danny, good to have you in here, man.
Always good to be here, man. I'm glad I got to help you break in the new set. That they can't see.
Yeah, that they can't see. But if you subscribe to the podcast, you get to see that set. And, of course, we send out emails daily on the new topics and things. You go, I wonder what they have to say about that. And I think it's, YouTube, a lot of this stuff shows up. I don't know, Stuart probably.
All good stuff.
We have him explain how this all works. I have no clue. Like some things I plan to be ignorant about as long as I possibly can. Yeah. And it's funny, I was the guy that had the first Palm Pilot in Goodlettsville.
Wow.
And had a laptop computer, used to send applications for, in my deep dark days when I was in the life insurance business, I used to send applications for life insurance in 1989 over the internet on a laptop computer.
I forgot about the Palm Pilot.
Oh yeah, Palm Pilot. That's right. It was. People would be like, "Paul, what is that?"
What was the other thing like the Palm Pilot?
That
I owned for a month or two.
Gosh, my mind just went blank. I never owned one. Anyway, so there was there was a segment on, I think it was CNBC. I think it was something about AI. And a lot of people, younger people, older people, I don't know. I don't know if it matters. It's all age groups will get pulled in on investing and thinking, wow, this is really, really great, and all these companies. But what companies have been driving a lot of the market gains in recent years? I mean, we can name them. Apple,
technology.
Amazon, yeah. We'll have NVIDIA, making the chips, and that's been making the news, of course, because of the new deals possibly.
Microsoft, Google.
Microsoft, for sure. So typically what happens is these very, very big companies, they may have technologies, and when we look at index funds, people hear this show and they think, oh, you guys are not stock pickers, market timers. That's not your method. What do you invest in? And they think indexes. And I often say, well, indexes are great in a couple different areas of the market. Large U.S. stocks, indexing works well there. Large international, it works really well there. If we look at other areas, small caps, look at value stocks, international small value, emerging markets, so on. It doesn't work as well. And the reason being is that the bigger companies are overemphasized in these indexes, and because the bigger companies are overemphasized, it tends to hurt long-term returns, and it can increase risk too. And the reason being is that big companies don't have as much room to grow. So hence we often go, indexing is great. And when we're dealing with 401ks, let me just say that, somebody brings in their 401k and says, hey, can you help us allocate this? We will usually try to find indexes in that case most of the time, unless there are other better alternatives out there. And the reason being is we'll try to find those things just simply because we know that they're not going to stock pick in market time. And you hear that all the time. Professional managers have a hard time struggling beating the indexes, and that's true. But if you want to make something look good, just compare it to something bad. An index compared to professional active managers, and you go, oh, they're looking pretty bad.
Or get rid of your bad fund.
Yeah, that's right. Oh, yeah, right. Survivorship bias.
Yes.
Yeah, exactly. So, that's a little technical idea that where a fund company will ditch their losing mutual funds to make their averages look better is what Danny's referring to there.
Well, referring to, this is things we talk about on a daily basis as new clients that come to visit us.
Yeah.
If they could really pick the stocks, and this guy got it right yesterday, how many stocks would you own?
One. That's it.
And yet, certain companies have...
Why would I own more than one? Why should I own 5 stocks?
And I don't name them. You can name them. I forgot what I'm allowed. Has 23 actively managed large cap funds, U.S. large cap funds. Mm-hmm. Why?
Yeah.
Why do you have 23? And one of the ones...
And it's well over 1,000 if you count all of the funds that they have.
Yeah,
so
in large cap alone, growth,
mm-hmm. Right.
23.
Oh, it is absurd.
Last I counted.
Yeah, it's absurd. Right, for sure. And, and these are big mutual fund companies.
Yes.
Typically we see these companies in 401ks on a regular basis.
Yes.
So anyway, the whole idea with AI is that it has been driving the returns of these big indexes because these companies that have been the developers of AI have actually been the benefactors of all of this new technology coming in. But this person made a really good point regarding AI that I want to share with you and how it typically affects markets going forward and what you want to be aware of as an investor when it comes down to, what could be ahead. The idea being that we think, oh gosh, markets are overvalued. And some areas of markets are very high priced compared to earnings. So, that is true. We'll see that some areas are selling for very, very high prices. But the issue is, are all markets overvalued, quote unquote? And we don't ever believe something's overvalued. Let me just make a point about that.
Very good.
Yeah, we don't make a point that we don't believe that. So it's properly valued based on all knowable and predictable information. But if we look at other areas and we say, gosh, has everything been on a big tear? And the answer would be no. So check this out.
If you have AI as a theme, themes play out over a number of years. We all know that. Nobody knows how long it might go on for. But if you have AI as a theme, you have to believe that eventually it starts to benefit other sectors. Okay. So from a market strength perspective, particularly a place like healthcare, you want to see healthcare start to take part in an AI trade. We watched something like utilities take part in that trade. We've watched copper and gold take part in that trade. Right. But we haven't seen other sectors benefit from a lasting fundamental perspective from the productivity that I still think AI can bring.
And that's the case. And, that's really what's going on right there is you'll have companies that aren't benefiting necessarily. They're not implementing. They haven't implemented fully the technology yet. So therefore, since they haven't implemented, they haven't seen the productivity growth that we are expecting out of them. And when they start to implement that can really bode well for those companies in the future.
Hopefully. So I guess, Paul, the latest iteration of AI, because if we just go back, AI's been around. If you've been around, right, around 10 plus years longer than you, so AI was different then, but this latest iteration is still in its infancy pretty much.
Oh, yeah.
And hopefully they will put it to good. Healthcare is the one that I'm like, hopefully they'll put it to good use in healthcare and help, sitting on a plane next to a nurse who says,
well, then there are a lot of areas that doesn't work that well too.
Yeah, well, she's saying that they're doing it, and they think they're getting close to a cure for Alzheimer's. That's what I want to hear. That AI is doing for me, not trying to figure out like what I need to buy because I looked at something online. So now it's.
I had a client, and he was a longtime producer of this radio show, but he actually sent me an analysis where AI analyzed all of the stuff that we've had, and we've been doing this show for 25 years, right?
Yeah.
Analyzed 25 years or as much information as AI could get a hold of to determine what I would recommend people invest in.
Wow.
It blew it. That's what I thought was so funny. It just blew it. So, there are a lot of areas it has a ways to go. Yes. But it is interesting that there are some things that it's really, really good at. And as time goes on, these companies are going to be utilizing this to everybody's advantage, and everybody's going to benefit from it. So
going back to where you started talking about the war, and this one.
Yeah.
When they ask AI solution, It opted for nuclear war on how to solve.
Oh, no.
Did you hear that one?
No, I did not.
The majority of the time said, just nuke them.
That's great idea.
Don't go to the peace table. Don't try to talk things out. Just nuke them.
No, that's great.
So it has a long way to go.
Yeah, it does have a ways to go. Okay. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.